right, we're glad you're with us. This is the Retirement Education Hour. Hi, everyone. Megan Mozak here, back in the studios today with financial instructors Kirk Cassidy and Michael Masserant. We sure are glad you're along for the ride. Today, we have another great program lined up for you today. And throughout the show, we'll be telling you about the Foundation's courses on retirement. And we say it all the time. These are really like master's level courses. And this is where we go deep inside this game of retirement, and we try to unpack it for you so that you walk away with more confidence. There's a lot to know, a lot of moving parts. The good news is we have instructors just like Kirk and Michael, and they're with you throughout those courses. So be listening how you can register, reserve your spot, and be there. But we have a great show that we want to get into today. I do want to give the website. It's retirementplanningedu.org, retirementplanningedu.org. And we'll jump into this today. You know, the financial services industry, the theme I come away with on this program is that this industry, they're not doing their job. They're not telling you some of the critical things that you need to know about your retirement. And especially this is true when we talk about the way you save your money and also the way you spend your money once you're retired. And these are two critical factors on this road, this journey to retirement. I want to get into this with Kirk and Michael today because when it comes to this industry, what they don't tell you can be incredibly damaging.
I think you're right, Megan. And that's our goal, right? Is not just what they're not telling you, but why they're not telling you so you can better understand the why. And then hopefully through our education, through the charity's education, we can explain what you really should be looking for is a solution to what is a very difficult phase of managing your money and your life, which is retirement, right? And as we start the show, I always like to try to remind everyone, Michael and I are actually volunteers for this national charity. Yes, we are fiduciaries. Yes, we have our own private practices, but when we're on the radio, Michael's on TV every week locally. And when we are teaching at major universities and colleges around Michigan, Missouri, and soon to be Pennsylvania, we are volunteers when we're doing those for a national charity that has now taught tens of thousands of people what is like an 8-hour master's level program, and hundreds of thousands of people are consuming our white papers, our webinars, and our content to better understand how to produce the best retirements possible. And so as we start today's show, I'm going to let Michael share a story, which was really where this show's content came from, Mike.
Yeah, so we talk a lot about how frustrated we are that this industry fails people who are retired because the industry tries to water down the planning advice they give people. And the reason for that is because the less you spend, the more they make. So we've been talking about that for a long time now. I was speaking with someone who was still saving their wealth. They were still 15, 20 years from retirement. They were in their, I think, late 30s, early 40s. And they were saying, Michael, it just feels like I'm not doing enough. All my friends, I hear friends, family, they have private equity investments. They have these REIT investments. They have this cash value life insurance. All I have are my index funds and my retirement accounts. And I feel like they're lapping me here. And I was explaining to them all the reasons where all these other sizzly nonsense investments, the private placements, the cash value life insurance really are not good tools to build wealth, to save wealth. And they asked me, okay, well, then why do my friends have these things? And I said, it's because the industry makes the savings phase of life overly complicated to generate themselves more fees. And it kind of hit me like an aha moment that the industry, when someone's younger, overly complicates the solutions to building wealth to generate more fees. And then when they're older, they overly simplify it to, again, speed up the process for retirees and simplify the advice and water it down to make the industry more profits.
Not only to make them more profits, but especially in the retirement phase, they oversimplify, cookie cut this so that they can meet more people, sell more things, and really, as a result, reinforce the fear and anxiety people have as they age and they retire about outliving their money. That is not unintentional because the less you spend, the more they make. And it's at the core of what we teach you in the class is how to find the right team so that you can spend more money, retire earlier, pay less taxes, and have less anxiety. So again, we'd encourage you to register for one of our 8-hour almost master level courses. If you'd like to register, go to refedu.org. That's refedu.org.
And so again, the frustration, I'm realizing, wait a minute. So the industry is failing people when they're younger. And then they're also failing people when they're older, but in opposite ways. When they're younger, they're making it more complicated than it has to be. But when they're older, and the planning should be complicated to give them a good plan, income planning, tax planning, they water it down. And again, they're both in both phases, they are misleading people because it makes their jobs easier, it makes their jobs more profitable. And the person who's hurt the most is the investor.
Well, it's driven by economics, right? And it's a shame because many of those people are, CFPs, they're fiduciaries, supposed to be acting in the client's best interest. And as far as an industry norm, they're behaving as a norm and they are behaving in the best possible way, many of them based upon the industry's norms today. And we're not even suggesting that people are intentionally misguiding or misleading people with malice always. I think people become a product of their environment and what they've been taught and what they've learned. And this is just the norm. The norm is when you're younger, the value proposition the financial service provides you is that they can stock pick market time and show you a better way to invest and save for retirement. And the value proposition in retirement is convincing you to make sure you don't outlive your money, almost like a pass fail, as Michael likes to say all the time. Retirement shouldn't be a pass fail. So today's show, we're going to talk about some obvious low hanging fruit, obvious mistakes that people are making when they're younger and we're not looking to get people upset or focus on the mistakes they may have already made, because many of you who are listening to us now, many of you, most of you have saved a lot of money and you're pretty close to retirement, many of you, and you've done a great job of many things, but there are areas in which you haven't done a great job that you don't know, and there are areas that you can impact for your children, your adult children, so that they can avoid some of these mistakes. So we're going to spend a couple segments talking about the mistakes that people are making when they're young because of industry norms. And then we're going to dig into, for like 3 or 4 segments, the mistakes people are making as they retire based upon industry norms. So stick around. And again, the goal of this show is to convince you that you need to attend what is like a master's level 8-hour course taught over 2 evenings or 1 full Saturday, taught at major universities and colleges, both Michigan and in Pennsylvania, some in Pennsylvania and Missouri. We also stream these classes live while we're teaching from the university so you can participate. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back in a moment. Plenty more straight ahead. You're listening to the Retirement Education Hour. And we're back. This is the Retirement Education Hour. Glad you're with us today. We're going to get back to our program here in just a minute. I want to pause to make sure that you have the information you need to register for the Retirement Education Foundation's courses on retirement planning. Now, these are held at major colleges and universities right in your community, and those include the University of Michigan, Eastern Michigan University, Michigan State University, both campuses Novi and Troy, also Oakland University, and the University of Missouri and Columbia College. Your choice. Head on over to that website now. Reserve your spot and make plans to be there. We'll see you at these courses. Retirementplanningedu.org is the website. Again, that's retirementplanningedu.org. You can also call to reserve your spot, 800-240-8981. These courses do fill up really, really quickly, and we want to make sure that you get there. So go online now. Retirementplanningedu.org is the place to go to make sure you're registered. We've been talking today about the financial industry and how they don't do a great job of telling you what you need to know, especially when it comes to how to save for retirement and what you can or what you should spend in retirement. Sometimes that's called accumulation and distribution. We're breaking that down with Kirk Cassidy and Michael Masserant, both are financial instructors with the Retirement Education Foundation. Now, as we talk about this today, let's start with savings, right? Where does that industry take us in the wrong direction, and how do we get back on track?
I think a couple important points is that as our listeners are listening to us, wherever you're consuming this, whatever radio station, podcast, however you're getting our information, we're a national charity, and we are representing that charity as volunteers who are trying to be as transparent about what really is going on in our industry, and more than what's going on, but why people are behaving from the financial service industry's perspective. Why do we behave the way we behave, those people who are providing services to the public? And then why does the public respond and behave the way they're behaving? And then ultimately, long story short, to get all the way around to what we have found to be the most effective approach to all phases of money and investing and income planning and tax planning from a charitable perspective. We are a charity. So without an agenda, we have biases. I'm not going to say we don't, but there is no agenda here. So the truth, here's the fact, is building wealth is fundamentally simple. It's not complicated in terms of what you should be investing in and how you should invest. I think where people struggle with that as a consumer is everyone's looking for an edge to get rich quick, the silver bullet. They're looking for something. And as a result, it allows the financial service industry, which is, in my opinion, really iffy at best from a trustworthy perspective, it gives them a really easy opportunity to have grifts and take advantage of people and misguide people. And even sometimes when it's unintentionally misguided information and misguidance recommendations, because they only know what they know. So if you just look at the economics of helping people in the first half of their life, even people under the age of 50, for the most part, there's not a tremendous amount of resources, Michael. And the way our industry gets paid, it really sort of directs people in our industry to go find other solutions so that they can make more money for themselves. So translate what I'm saying, Michael.
Yeah, so I'll give an example as to.
Did I
kind of
catch
put
you
some
right in the middle
numbers.
of when you were going to sneeze? That was pretty funny.
You
I
did. So I'll give you an example to kind of put some numbers to this. So actually, a couple of friends of mine, they're in their mid 30s. They just got married recently, and they were asking me about advice about saving for retirement, and they kind of showed me all their numbers and everything. And they have approximately $350,000, $400,000 saved for retirement, which is great
They're
for
doing
someone
good.
in their
Yeah.
mid 30s or so. They both have great careers. And they said, the person who helps them with this was recommending them two questionable things that kind of triggered them to ask me for my advice. One was a whole cash value life insurance policy, and one was
Like
a
a power
private.
of zero,
Yep.
misfortune, bank on yourself.
And one was a private equity investment for privately owned different companies. And they
Yeah.
said, why would they offer this to us? We didn't really ask them for these things. And I said, listen, here's the deal. They've been trained to offer you these things. So this company is charging you probably 1% to manage your $300,000. 1% of $300,000 is $3,000 a year. And your advisor does not keep that $3,000 a year. Your advisor probably keeps 10% of that, 20%
15,
of that.
20%.
So
Yeah.
they're making like $600 a year to help the two of you. And your advisor probably, has, I'm sure, other clients, but they can't get by if they're just making $600 a year off of you.
Nope.
They need to sell you something else to generate a commission for their own lifestyle. Now, that advisor that's helping them may not realize this is why they're doing that. They may have been trained, oh, well, you got to help your clients by selling your clients this life insurance.
I believe that to be more common than the latter, someone trying to take advantage of them. But go ahead. I want to give them the benefit of the doubt.
So my friend's advisor may have the best intentions in the world, but not really realizing, oh, well, I'm offering this to my clients because I've been trained to do it. And that advisor's firm has, trumpeted, these are great products you should sell to all your clients, but they're really not. If you sat down and broke down the numbers of the outcomes of investing in these other commission-based products versus just throwing the money in the indexes, they'll be better off in the indexes. But the advisor and that advisor's firm can't get by on earning $600 a year from their fees.
So next segment, stick around. We're going to talk about those different products that even many people in their 50s still are using and owning, and people are trying to sell you. We're going to talk about the economics of them and the outcomes of them. Because look, anyone that's telling you anything other than when you're younger, especially, you should be investing in the index. Nothing beats the index. I mean, the numbers don't lie, Michael. The numbers are really clear that all the managers, money managers, and there's thousands of different mutual funds and money managers out there. 92% of the time, the S&P 500, the index is going to beat those managers over a 10-year period of time. And over a 20-year period of time, 96% of the time it's going to win. And you're talking about thousands and thousands of people. You're looking at diamonds. You're looking for needles in a haystack. It's It's crazy. It's not that hard. It's really simple when you're young. There's not a lot of complexity to investing in savings, and they overcomplicate it every time. And here's the deal, and maybe we'll talk about the fees in the next segment, but really our goal is for those people within 10 years of retirement through retirement, you have to attend one of the charity's 8-hour master level courses. You $1 to $10 million families, especially engineers, executives, CEOs, CFOs, CPAs, attorneys, you guys need to attend this course. You don't know the right math. You don't know how to choose the right teams. If you'd like to register for one of these courses, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back with Kirk and Michael right after this. Happy you're with us. This is the Retirement Education Hour. Are you registered? That's the big question. Of course, the Retirement Education Foundation holds courses. We've been telling you about these. They're like master's level courses on retirement planning, and you owe it to yourself to be there. We want to see your face in the crowd. So be sure to register. Here's the website to do that. retirementplanningedu.org. That's retirementplanningedu.org. Or you can call 800-240-8981. Make sure you reserve your spot at the location and on the date that works best for you. And the locations are at major colleges and universities near you, including the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College. So again, go to the website right now, retirementplanningedu.org. We've been talking today about the financial services industry. Boy, they sure don't tell us what we need to know. And the good news is we've got Kirk and Michael here. They're in our corner, and they're helping us expose some of this. And it's pretty gnarly when you think about it, when you think what's at risk, only your life savings. And speaking of savings, this is where it starts. It's in that accumulation period when you are saving for retirement. And there's a lot. In fact, we were talking about this just before the break. We're going to keep rolling here on this because there's so much to talk about.
Yeah, Megan, I think, of course, the show is really predominantly focused on retirement planning, right? In from a charity's perspective, teaching you and educating you. So I don't want to spend too much time on this, but let's do this a little rapid fire, Michael.
Mm-hmm.
So the average cost of an actively managed mutual fund with an advisor is going to cost you somewhere between 1.5% and 2.5%. Your net expense ratios are not all the fees. If you want to understand more, come to the class. We'll teach you. But really, in this today's world, no one should own actively managed mutual funds anymore. There is no reason to. You are literally looking for a needle in a haystack, and you're not going to find it. So, Michael, let's talk about a couple things. Obviously, actively managed mutual funds, bad. I sort of hit that. Let's go to cash value, because this is being sold a lot right now. This whole, the power of zero, not paying income taxes in retirement, instead of saving to your retirement account, save to life insurance. Talk about that a little bit, because this has been around since the 80s, by the way.
I probably see videos on this, whether, on YouTube or Instagram, or I have friends send me TikTok reels about all these things of cash value life insurance, and they make it sound fantastic. Build up cash value life insurance policies. You can borrow against it tax-free. It sounds fantastic. The math does not work out. If it was as great as what they claim it on the 60-second video, everyone in the world would own this stuff. But not everyone does, because the math doesn't really work out. When you start to borrow against the policies, more often than not, they implode on themselves.
Michael, since the 80s, it started with a book called Misfortune 101. And then it was Bank on Yourself. Now it's Power Zero. And there's all kinds of different iterations of this strategy. This is nonsense. If it wasn't, listen, my firm, outside of this charity, I have a private practice. We are responsible for over $2 billion. We're a high net worth family office. Trust me, for decades, I had been using this strategy. It is nonsense. It's not going to work. I know it looks pretty on paper. I know the sales pitch. Please hear us when we tell you, when you go to retire and take money out of these accounts, the math won't work. You would have been better putting your money in the retirement accounts. Even if you had to pay tax on it, you're going to come out ahead. I can just tell you thousands and thousands and thousands of analysis we've done on these things. Okay, REITs or private placements. Before that, I'll say this real quick. Anytime you hear the democratization of investing, Michael laughs. No, I'm serious. People get pulled into this.
Yeah.
This grift and that expression is actually, it started the Great Depression. Go back in history and look at, they were talking about the democratization where brokers were lending money for people to invest in the markets. This is what caused the major crash in the market. This whole concept, anytime someone says the democratization of investments for the middle to lower income people, this is a grift. You're about to get scammed. Hold your wallets. They are playing on your emotions of the rich are getting something you don't get. And sometimes there's a reason you shouldn't be investing in some of the places the rich. They can swing and miss a lot more times. This is a grift to take fees, Michael.
We met someone at the class who had roughly 40% of their net worth in an illiquid private placement, and they got sick and they could not sell that investment to fund their health care. It was a disaster.
It's all the time. Listen, REITs are high commissions, often illiquid, not enough. They won't beat the S&P 500. Michael, you just looked at the real estate market from 1980. We just did this show on another medium. You just did this. From 1980 until 9, the real estate market is appreciated, what was it, 800%?
Correct.
800%. Do you know what the S&P 500 has appreciated? The return on the S&P 500 since 1980 till 9?
If you reinvested the dividends since
Yep.
1980 until today, roughly 18,000%.
Right. $100,000 invest in the S&P 500 since 1980 till now. That's $18 million. Did I do my math right?
Yeah.
That's crazy. Now they're trying to have give people access in their 401ks and their retirement accounts into private capital markets.
Private credit, private equity.
Please listen. The reason why the wealthy can do private equity, they can do venture, angel, they can do all these types of alt type of investments and win is because if they swing and miss and lose 9 out of 10 times, they can afford it. They're looking for the 1 in 10. You do not have the resources to play that game. You don't. It's not hard. You guys are looking for silver bullets, and it's super simple. Here's what you should tell all of your kids. They should invest their money in the index. Anything for retirement should be in the index. They shouldn't own any bonds, and don't worry about if the market goes up or down. Don't even look at your statements. Make sure they're increasing their savings automatically every single year in their 4s until they max it out. You're going to need to save a lot more money, and most of them should be saving money in the Roth provisions of their 4s. The Roth provision of their 4s until their early to mid 40s. We've done the math. It's not hard. They don't need to pay advisors' fees. They just need to make sure they're disciplined and they're saving and buying the index.
That's the game plan.
Quick.
It's not sexy, but that's the game plan.
Yeah, any short-term money, any homes, anything you're going to buy in the near term, that's where you got to get conservative. Enough with young people. We are trying to help a little bit and give parents a tool to go back to their adult children. Again, sign up for one of our 8-hour, almost master level courses taught at major universities and colleges in your area. We also stream them live from the universities so that you could attend wherever you're at in the country. And all we ask for is a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back right after this. You're listening to the Retirement Education Hour. This is the Retirement Education Hour. Glad you've joined us today. We're talking today about the financial services industry, what they may not be telling you, right? Both about how you're saving for retirement, but also what to do once you're in retirement. Michael Masserant, Kirk Cassidy, they're both here. Kirk and Michael, they are financial instructors with the Retirement Education Foundation. They're setting us straight. They're kind of pulling back the curtain on this industry so that we're all in the know, so that we can course correct if needed. And we've been talking about these missteps that some of us make due to this lack of information, both in the savings period, but also once you cross that threshold into retirement. And boy, you don't want to make any mistakes then. So we're going to continue that conversation, but I do want to pause to give you the website for the foundation. This is how you register for the foundation's courses on retirement planning. And remember, these are master's level like courses. They're held at major colleges and universities near you. Here's that website, retirementplanningedu.org. That's retirementplanningedu.org. The courses are held at the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College, and they are always opening up new locations. So again, go to the website, retirementplanningedu.org, or call 800-240-8981. We talked about some of the things this financial services industry gets wrong in the savings portion, but there are things that they just kind of conveniently don't tell you once you are retired. This is the distribution phase. Let's talk about that.
Yeah, I'm hoping anyone who's listening, even if you're driving, sit in the car and listen to the next couple of segments, because I think this is going to be really enlightening and helpful for you. Because as we said earlier in the show, building wealth is fundamentally simple. It really isn't that difficult. I'm not saying it's not. Let's rephrase that. It is hard to build wealth in terms of saving enough and making the right choices. But what to invest in to build wealth is super simple. I think that's a better way to say it. The difference is turning wealth into income is fundamentally super complicated. And the fascinating part of this is the industry does this thing in reverse. Like, they want to make the saving part complicated and what to invest in complicated when you're younger. But what, and as Michael said when earlier in the show, they make the retirement planning simple, and they make it simple for a lot of reasons. And I'm going to give you the whys, and then we're going to talk to you about some of the things that you should be doing and what outcomes you should be able to produce versus what you're actually currently getting. The more simple it is, the more scalable as a business it is. So if something is cookie cutter and repeatable and streamlined, that gives them more time to sell, accumulate more assets under management, and build a bigger business. Listen, everybody in this industry is in business to make money. That is the easiest way to be able to make money in retirement. So that's one. Two, no one demands more of them because they have conditioned you your whole life to be afraid as you retire. In fact, the number one fear of a retiree is outliving your money. That isn't an accident. They've taught you to have that fear. They've also taught you should protect your principal. So they've told you to protect your principal because you're worried about living your money. And they've taught you that retirement planning is a pass-fail grade. Passing, you don't outlive your money. Failing would be outliving your money. All of this is nonsense. There is zero incentive for the financial service industry. There is no incentive, none at all. Fiduciary CFPs, any of them, there's no incentive for them to build you an individualized, comprehensive retirement plan. Because if they did, you could spend a lot more than what they're telling you can spend. You could spend a lot more than 4%. You retirees in your 60s should be spending 6, 7, 8, maybe 9% per year out of your investments and not worry about outliving your money. But it would require so much more time. It would cost the advisor so much more money to build, and they would be losing money. The more money you spend, the less money they make.
So that's something, Kirk, that you say a lot on the show. And I'm not sure that people always put the math together in their head of what that really means. So if you think about if someone is retiring with $2 million and they spend 4% per year, $80,000 per year,
Yep.
They will probably pass away with more than $2 million when they're in their 90s because their portfolio will likely outgrow that $80,000 per year withdrawal. That means that advisor is going to get to bill their AUM management fee of, let's call it 1% per year every single year for the rest of that person's life on a balance of a portfolio of $2 million or more.
Yeah.
So that's great for the advisor. That's not so great for the client if they're looking to retire sooner or spend more. Now, if that advisor spent more time to build a customized plan to let that client spend more money, 5, 6, 7, 8% per year, which we talk about in the class, how we show how it's possible.
Which we show on the charity's website, the sample plan. Just go to the charity's website. Go look at the sample plan, right?
Yeah, that one they have an 8% withdrawal rate, and they
At
have
65
cash flow they can never outlive. And so the difference is that they're spending their principal down over time, meaning that whoever is helping them is making less money every single year. And that's not in the advisor's best interest. That's where they're conflicted.
You nailed it, Michael. And I'm looking at our clock to see if we're on time, and I'm having trouble seeing it. And I think you are too. So actually, we have more time. So it's good. So I want to throw it back to you for a little more. I would say, look at the charity's website, Go look at the webinar. Specifically, it says sample plan, and you're going to see a 65-year-old taking 8% withdrawal rates. And there is risk mitigation built into those plans so that they can never outlive their income. If a spouse dies early, if there's a long-term care event, if we have a great recession, there's nothing that can break that plan. But there's no incentive for them to build you those plans. And the listeners, Michael, they don't know what to look for. That's the purpose of the charities. How do I find a team that provide this? What is the math?
And unfortunately, like you said earlier, the industry is really good at scaring people. Oh, you can't spend more because the stock market's unpredictable, your health is unpredictable, inflation's unpredictable, politics are unpredictable. So for all these reasons, you need to spend less and you need to have a lot of wealth when you're in your 90s just in case. And people hear that they go, "Okay, I'll spend less. My advisor told me to."
I don't want to let my money. I'm afraid.
So they're playing on those fears to get people to spend less money. That makes the advisor more money. It gives them less work to do, and they make off like bandits.
And I want to be clear again. People don't, the industry, people in our business, the financial service industry, don't always know what they don't know. So I'm not accusing everyone to being a bad advisor or doing something. I'm not saying that.
That's a very good point.
So I'm not trying to paint everyone in the same light. What I'm saying is they are a product of their environment and they only know what they've been taught. That's it. So the purpose of the charity's 8-hour, almost master level course is so that the consumer, you $1 to $10 million families, will actually know what to look for in a team, what questions to ask, what are the different levers that should be included in a retirement plan, and how are you going to risk mitigate against outliving my money so I can spend more money in retirement. So this is why you need to attend an 8-hour course. So you're just educated, empowered to find the right team so you can have that retirement. If you'd like to register, all we ask is a $29 donation. Go to charity to register. Go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back with Kirk and Michael right after this. This is the Retirement Education Hour. Glad you're with us today. Megan Mozak in the studio with financial instructors Kirk Cassidy and Michael Masserant. Both of them, they're here. And we are so glad especially because of the topic today, where we're talking about the financial services industry, what they're keeping from you, what they're not telling you at these critical moments of your life on your journey to retirement, the savings period, the spending period in retirement, accumulation, distribution. Yeah, there's a lot they're keeping from you, and that could be incredibly damaging to your financial future. And as we talk about this with Kirk and Michael today, we're going to make sure that you are armed with the information you need to feel confident. The other way we bring confidence, the foundation offers courses on retirement planning. And these are like master's level courses. We want to see you there. And this is where you can walk away with a lot of confidence about your retirement future. It starts by getting registered. So go to the website right now, retirementplanningedu.org. That's retirementplanningedu.org. Or call 800-240-8981. That's 800-240-8981. The courses are held at major colleges and universities, including the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, Columbia College. Man, the list just goes on and on. You will find a location near you, and we want to see you there. So register today, retirementplanningedu.org. All right, Kirk, Michael, let's dive back into this. There are a lot of people listening today who are working with an advisor, and they think they have a comprehensive plan for retirement. But you say there might be some red flags to look out for because you actually might not have the type of plan you think you do.
Well, I mean, I think that's a great way to phrase it, and I would extend it even beyond just working with an advisor. We see this a lot with people who are managing their own finances going into retirement, but they're leaning on conventional wisdom, reading all kinds of research and different retirement books and planning strategies, and they're learning these things. And there's a couple of things. Look, the average baby boomer will retire with about $250,000 saved for retirement. So many of you who listen, who attend our classes, who are consuming our content are not close to average. You $1 to $20 million families are not average baby boomers, not even close. The average is 250, and almost 40% of baby boomers only have Social Security to live on. That's all they have. So this conventional approach, the conventional wisdom is failing people and is going to result in you way underspending Our fear for most of our listeners and people attending class isn't that you're going to outlive your money. Our fear and we know, we have been tracking this for a long time. It's not you're going to outlive your money, that you're going to way underspend what you otherwise should and could be spending if you had a comprehensive, individualized plan for yourself and you were with the right teams. That is the whole purpose of the charity, is to help you find those teams to give you the information to do that. And Michael, some of the flags that are like super simple, give us some of them.
So for people who are working with the team, there are two phrases that I wince at every time I hear them. People say, "Oh, well, I've got a team and my team says that they'll build me a plan when I get there." That boils my blood, because first of all, how do you know when you're there if there's no plan built? That's so frustrating. Many people are there already, but they haven't pushed their team for a plan yet, so they haven't gotten a plan.
There's no incentive for them to get you retired, by the way. They're not going to tell you go retire.
The longer you work, the more you save, the more they make.
That's right.
The second thing is that if you aren't there yet, okay, are you making every proper choice to get you there faster? Are you saving into the right account? Should you be saving into the Roth or pre-tax or brokerage accounts?
So, Mike, I'm going to interrupt. That's goal-based investing. That's everything is driven by, what do I need to give me the retirement I want? And if someone is saying to you, once you get there, we'll build you your plan, fire them tomorrow. I'm serious. Fire them. It gets me so angry. Every decision you make within 10 years of retirement should be based upon the math, your plan, a individualized plan, so that you can accomplish that most effectively. Go ahead. Next slide.
The second phrase that drives me crazy is, "Oh, you're good. You don't need a plan. You're good.
Oh my God.
You've got, $3-4 million. You've done a great job saving. You're good. Don't worry about a plan."
When you come to the class, you're going to see if someone has spent, the plan that you go to the charity's website, you'll see a sample plan that we actually teach based upon that plan in the class. That plan takes 50 to 70 hours to build. Hundreds of iterations with CFPs, CPAs, attorneys, and wealth managers. Hundreds of iterations. And the result is you will spend a lot more, 6, 7, 8, 9% withdrawal rates. You're going to pay significantly, often hundreds of thousands of dollars less in taxes. You're going to have so much less anxiety because you're going to have all the risk mitigation for if one spouse dies early, if another spouse dies at this age, if you have a long-term care event in your 70s, in your 80s, all major market events, a plan will risk mitigate for that. Someone says that you're good, that's pass fail. Do you want an A plan or an E plan?
And that's exactly it. Two things. The industry knows that by just saying, "Oh, you're good, don't worry about it," they know you're going to worry. And they know you're going to spend less. And they know that means that your portfolio won't shrink. They'll make more money. That's number one. And number two, okay, if you're good, that's great. But you've been saving for 20, 30, 40 years of your life. And you're just kind of at the finish line. You're going to shrug your shoulders and go, I'm good. I don't need to be efficient anymore. What? Are you kidding me? What did you work so hard for? What did you save so well for to just throw it away at the finish line?
It drives me crazy. Michael, I'm going to give you another one. If they're talking about a 4% rule, fire them tomorrow. If your plan has a dial and it says a probability of whether you will outlive your money or not, I can guarantee you that plan is not individualized for you. That is a software. And I'll give you some of the names: eMoney, Money Guide Pro, Right Capital, Retirement Analyzer. Those are cookie cutter interns spitting out data, taking out 4% a year, not managing sequence of returns risk. Not the secret to performance in retirement is taking money from the right accounts if the market's up versus different accounts if the market's down. Then there's risk mitigation. Then there's all these tax issues when one spouse dies. There are so many variables. So if you just have a spreadsheet with 4% coming out, inflating by 2.5% a year, that is not a plan. That is not for you. That's cookie cutter.
And I know, Kirk and I get a little manic trying to bounce back and forth to fit all these talking points because we only have so much time here. That's why the class is 8 hours long. It's not 8 hours of fluff. We're going through 8 hours of a lot of content to really try to explain to people all the things they need to be aware of when they're picking a team.
Next segment, we'll talk about who the class is appropriate for. Okay. This class will change your retirement. Yes, I'm talking to you $1 to $20 million families. This will change your retirement. I promise you, you will come away with the ability to find the right teams so that you can spend more, pay significantly less taxes, drive much better real returns, and have much less anxiety and fear because you're going to understand the different risk mitigation tools that should be in your plan. So if you'd like to register, we just asked for a $29 donation to charity, and it's 8 hours. It's 8 hours spread over 2 evenings or 1 full Saturday, taught at major universities and colleges in your area. And we stream it live if you're out of that state. Go to retirementplanningedu.org.
And we'll return. There's plenty more. You're listening to the Retirement Education Hour. And we're back. We're glad you're with us. This is the Retirement Education Hour. Megan Mozak here with you. And of course, I'm with financial instructors Kirk Cassidy and Michael Masserant. They are both with the Retirement Education Foundation. You know, the foundation makes education its mission. That's what it's all about, educating you around this huge topic of retirement planning. So much so that they dedicate full courses. These are like master's level courses to the topic, held at major colleges and universities near you. And here's how you can attend. Just reserve your seat now at the website, retirementplanningedu.org. That's retirementplanningedu.org. These courses are taught at the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, also on that list. You can also attend at the University of Missouri and Columbia College. Get all the details over at that website, retirementplanningedu.org. You can also call 800-240-8981. Talking today about the financial services industry, what they haven't been telling you and how damaging that can be to your retirement journey. And we've learned a lot, right, from Kirk and Michael today. There's a lot, maybe, some of us don't know because we're just not working with the correct advisor, right?
Yeah, that's 100% true. I think part of the problem is sometimes the advisor is not doing what's best for you because they are doing what's best for them. I think more often than not, the advisors are doing what is industry norm and they perceive to be best for you, but they don't really understand what can drive and what is potential driving the best outcomes, particularly when it comes to retirement. And so what I really, anyone that listens to our show on a regular basis knows that we always come, the last segment is about the solution, and planning is the solution. Education is the solution. Everyone understands we're a national charity, that we've taught tens of thousands of people and hundreds of thousands of people consume our content. And these classes, by the way, are just part of the charity. The charity does a lot of things, including financial literacy for young adults, juniors and seniors in lower income communities and high school. So what I really wanted to do in this segment was I wanted to throw out a few more cautions that jump to mind, because a lot of you are listening to financial experts on radio shows, on TV shows, and it is so hard today to know. People, they create a perception that isn't always reality. Like if anyone's talking safe money strategies, that is an insurance salesperson. If someone's talking to you about it or recommends you putting 50, 60, 70% of your money in insurance products, run. Okay. And I know who's on the radio locally here in Ohio, in Missouri. I know it's a bunch of insurance salesmen pretending to be, that is the purpose. They're pretending and they sound very compelling, but that is the purpose of the charity, is to arm you to not get taken advantage of. And the problem when we say these things on radio and we say these things on TV, people say, that's not me. I'm highly educated. I'm really smart. I've saved 5 million, 7 million, 10 million bucks. I know exactly what to look for. And the truth is, and I'm not picking on you guys, you don't know. In fact, you are way too overconfident and you're the easier targets to take advantage of, frankly, particularly when it comes to retirement. And so let me tell you who is typically consuming our content and attending our courses. It is predominantly the $1 to $10 million families. Yes, we have some that are under 1 million. And yes, we have plenty that are over 10 million, but predominantly the sweet spot of people consuming the content and attending our courses are $1 to $10 million. And they tend to be engineers, CPAs, attorneys, executives, small business owners. These are the people that seek out information and education. And you need to know this course is for you. This is like a master's level course, and we guarantee that when you leave this course, the charity guarantees when you leave this course that you will be so much better prepared for retirement. Your retirement will be so much better because you will be able to find the right people to help you so that you can spend more money in retirement. Not a little, a lot more. Instead of 4% a year, 7 or 8% a year in retirement you can spend. You'll be able to retire earlier. You'll pay significantly less taxes because you'll know if someone's really doing the right Roth converting strategies, taking the right income from the right places, or it's a software, or if it's someone just selling software services as a lead source to get business so they can sell you an annuity. You don't know the scams that are out there. We're going to teach them to you, and we're going to then teach you the levers that will drive your success, to drive your performance, and the levers that will mitigate the risk. You have to understand specifically what is going to mitigate risks as I age, or you will shut down and not spend money, Michael.
The tricky piece to this is that we often get people, emailing in from the radio shows or whenever they see me on TV here locally. And
I'm different.
I just have, one question. No, I got all my stuff dialed in except for Social Security. When should I take Social Security? And I always find myself, drafting a 4-page email response explaining that it depends. It depends on what tax bracket are you in. It depends on what your RMDs are going to look like. It depends on what Roth conversions are you doing. It depends, are you married or single? It depends on what your spouse's Social Security is. And once I'm 4 pages into this drafted email, I'm like, you need to come to the class, because these are all the things, instead of me spending 3 hours drafting an email that you're not really going to read because you're looking for a quick answer, just come to the class, because everything is based on the plan, based on the math.
You know what Social Security is, the baby boomers? It's crack. Literally. Look at all the social media. You guys, if it says Social Security, you jump at it. Social Security, it's a math problem, and it's a tax problem. When you take Social Security, it impacts your taxation on RMDs, it impacts your taxation on dividends and capital gains, it impacts the surviving spouse. Once the first spouse dies, their tax bracket significantly increases. There are so many different math problems, and you're not doing the right math. They're not teaching you the right math. That is the purpose of this class. Social Security recently posted something. 92% of people taking Social Security make the wrong decision. That's the facts.
And people will,
with all these resources,
people will pick whatever their bias is. Take it early, take it late. But the math will teach you these things. And if you think you're doing the right math, we've met a lot of engineers who are doing the break even on, when they're going to pass away. That's not the right math.
No, listen, this is all a math problem. The plan should drive every decision, not your emotions or feelings or opinions, not your advisor's emotions, feelings, or opinions. It's the plan, but you don't know the math and the plan. So you need to attend one of our 8-hour almost master level courses taught at major universities and colleges in your area. All we ask is a $29 donation to charity. Go to retirementplanningedu.org. That's retirementplanningedu.org.
Retirement Education Foundation is a fiscally sponsored program of United Charitable, a registered 501c3 public charity. Investing involves risk, including the potential loss of principal. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Retirement Education Foundation is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Retirement Education Foundation is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is paid for by the Retirement Education Foundation, a charitable program.